Good day and welcome to Q3 FY23 earnings conference call of Go Fashion India Limited. This conference call may contain forward-looking statements about the company which are based on the beliefs, opinions and expectation of the company as on date of this call. These statements are not the guarantees of future performance and involves risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Gautam Saraogi. Thank you and over to you, sir.
Thank you. Good evening and a warm welcome to everyone present on the call. Along with me, I have R. Mohan, our Chief Financial Officer, and SGA, our Investor Relations Advisor. Hope you all received our investor deck by now. For those who have not, you can view them on the stock exchange and the company website. The company has shown strong performance in Q3 FY23. Our revenues grew by 24% to 177 crores, highest ever quarterly revenues at Go Fashion. EBITDA and PAT grew by 14% and 3% respectively to 59 crores and 24 crores respectively. This has been on the back of high volume growth and improved product portfolio. Our revenues compared to Q3 FY20, which is pre-COVID levels, has increased by 51% for Q3 FY23. SSG for EBO stood at 18% for Q3 FY23 compared to pre-COVID levels, which is Q3 FY20. SSG for EBO is at 10% compared to last year's quarter 3. For the quarter, our overall volume growth has grown by 17% compared to last year. Compared to pre-COVID levels, our overall volume has grown by 28%. Our product being core and essential to customers has enabled to operate us on a business model where we offer limited discounts and the sale of our products is typically at full price, which is in our experience results in greater profitability. 96% of our sales in the 9-month FY23 are at full price sales. In addition, our EBO average selling price has increased continuously, primarily on account of value-added products that we've introduced as part of our product portfolio. Our ASP for the 9 months stood at rupees 724. As mentioned in our last couple of calls, the company is investing in brand building initiatives which will help us in gain visibility and help us focus to grow our online sales channels to benefit the evolving customer trends in the market. During the last quarter, the company has had a brand campaign, Good to Go. This activated 53 mega and macro influencers across 8 cities and reached 36 lakh unique audience via influencer marketing. The approach was to reach out to audience which have affinity to the brand, also the audience who are currently in the concentration funnel of purchase. We reached 82 million audience and the recall lift at 23% after 60 days. During Q3 FY23, the company added 35 new EBO stores and the total of 101 stores in the 9 months FY23. This takes the EBO store count to 604 as on 31st December 2022. As guided earlier, we will continue to add 120 to 130 stores in FY23, which is in line with our growth expansion plans. We are looking at omni-channel engagement for a seamless customer experience, building on a technology-driven strategy to reach consumer across all cities. We are leveraging technology to bring cost efficiency and enhance customer experience. We intend to further improve our operating efficiency and ensure efficient supply chain management through global best practice. We will look to upgrade our warehouse to optimize our inventory and supply chain management. Coming to the working capital front, we have reduced our working capital days to 151 days as on 31st December 2022 compared to 178 days as on 31st December 2021. We are further working to reduce it mainly on the inventory front. On the cash flow front, we have delivered a positive operating cash flow of rupees 60 crores for the 9-month FY23. We look forward to continuing our innovative and creative approach and launch more designs while providing more brand destinations for our consumers, which will help us grow and gain market share in the coming years. Our focus will be to target customer acquisitions to drive sales through our website and online marketplaces. In addition, we intend to invest in content generation to build engagement with the younger audience. With this, I would like to hand over the call to our CFO, Mr. R. Mohan, for the update on the Q3 and 9-month FY23 financials. Thank you.
Thank you, Gautam, and good evening, everyone. The company has posted strong performance for the quarter and 9 months ended 31st December 2022, backed by the increased demand across product categories. Our revenue for the quarter stood at rupees 177 crores as against 142 crores in Q3 FY22, a growth of 24% Y-on-Y. Gross profit stood at 104 crores, a growth of 21% Y-on-Y with a GP margin of 59% for the quarter. Our EBITDA for the quarter stood at rupees 59 crores as compared to rupees 52 crores in Q3 FY22, a growth of 14% Y-on-Y. Our EBITDA margin stood at 33.5%. Profit after tax for the quarter stood at 24%, rupees 24 crores, a 3% Y-on-Y growth from Q3 FY22. PAT margin stood at 13.8%. Coming to the 9-month FY23 performance, revenue stood at rupees 508 crores as against rupees 285 crores in 9-month FY22, a growth of 78% Y-on-Y. Gross profit stood at rupees 303 crores, a growth of 79% Y-on-Y with a GP margin of 59.7% for the 9 months. Our EBITDA for the half year stood at rupees 162 crores as compared to rupees 81 crores in 9 months FY22, a growth of 99% Y-on-Y. Our EBITDA margin stood at 31.8%. Profit after tax for the 9 months stood at rupees 68 crores as compared to rupees 23 crores in 9 months FY22, a growth of 192% Y-on-Y. Profit margin stood at 8.2%. The ROCE and ROE on an annualized basis stand at 19.8% and 17.8% respectively. With this, we will now open the floor for the question and answer.
Thank you very much. We will now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Anyone who wishes to ask a question may press star and 1 on the touchtone phone. We take the first question from the line of Ankit Kedia from Phillip Capital. Please go ahead.
Sir, just wanted to understand the volume growth for the quarter. Given that you have posted 17% YOY growth, but you also had a 27% area or store addition. And SSG, ASP growth is also around 10-11%. So what is the volume growth in SSG and how has been the new store impact on profitability and volumes?
Yeah, thanks, Ankit. So from an SSG perspective, this year we've had a 10% value growth over last year Q3 FY22. So the value growth is at 10%. The volume we have seen a degrowth of -2%. But our business, like I also mentioned earlier, is becoming more of a cluster-based business. So this quarter we have seen where our SSSG has stood at 10% and -2% on a volume level. Our SCSG, which is same cluster sales growth, has stood at 24% on a value level and 11% at a volume level.
And this is YOY?
This is all YOY. So this I'm telling you as a comparison between Q3 FY23 versus Q3 FY23.
Sure. And sir, from a cluster-based approach, how many clusters do you think, or how many stores do you add in that cluster? Of how many kilometers is that cluster, and how many stores out of your 600 odd stores are in this cluster-based SSG?
See, I would say about 60 to 70% of the stores, about 50-60% of the store, a little more than that, are in clusters. But how many stores we can have in a cluster is very subjective to that particular location. So every area, every locality is different. There are some localities where in the entire cluster one store is enough, and some localities where the area is very the area of the cluster is very small, but multiple stores is required. So it really, like, I'll give you an example now. Let's take Mumbai, right? So Linking Road is one cluster, the Bandra cluster. Linking Road, if you have one store for the entire road, it is enough. But whereas if I take the Dadar market, Dadar store in that small Dadar West area where the shopping is there we can have a potential of 3 to 4 stores. So it really depends from market to market.
Sure. So going forward, is it fair to assume the volume growth on SSG basis would be low single digit or flattish, while on the cluster base it could be a higher growth?
See, though we are going to be a cluster-based model, but at an SSG level, we are going to continue aiming to have a volume growth of 4 to 5% on an SSG level. See, this quarter, the overall retail market the overall festive quarter was a little slow. That is why we've seen a degrowth of -2%. On a generalized basis, we are aiming to maintain that volume growth of 4 to 5% on a SSG on a YOY basis.
Sure. So my second question is regarding your working capital.
On an overall basis, we are more of a cluster-based growth model than an SSG model.
Understood. So my second question is regarding your working capital. If I look at on a quarter-on-quarter basis, the cash on books have actually reduced. While you are saying your operating cash flow is 60 crores, I believe that is post in that operating cash flow. So if you can just help us, with the absolute inventory number for the December ending number, so that will help us understand the actual, working capital.
Yeah. So I'll explain the benefits. So our absolute inventory is around 223 to 225 crores in the books, which is including finished goods and raw material. Now, very rightly you pointed out, this cash flow from operations which you see at 60 crores, this is post-Ind AS basis. If I take pre-Ind AS basis, this 60 crores will actually be zero, because we have a rent outflow of about 60 to 61 crores. So if we net off the rent from the 60 crores, the 60 crores becomes zero. So from a cash flow from operations perspective, it stands at nil on a pre-Ind AS basis.
Understood. That's helpful, sir.
But what happens is the working capital also includes the inventory for the newer stores what we've opened. So this zero cash flow from operations what we have, it is post the inventory what we've added for the new store.
Sure. So, but if I look at your, September inventory was 215 crores. So approximately 8-9 crores inventory has been added. But that inventory was also slightly on the higher side, because as cotton prices are falling, you would be using the high cost inventory and securing low cost inventory. So shouldn't the inventory absolute amount decline?
See, currently, Ankit, we are at 4 months of inventory, and we are looking to optimize our inventory, and we have been doing it over quarters, and we are looking to bring it down to 3 months. So this optimization to 4 months to 3 months will take a few quarters, but we are aiming to bring it down to 3 months. And that is how we are going to be reducing our overall working capital.
Understood. I'll come back in the future. Thank you.
Sure. Thank you, Ankit.
Thank you. We'll take the next question from the line of Mr. Devanshu Bansal from Emkay Global Financial Services. Please go ahead, sir.
Yes, sir. Thanks for the opportunity. Sir, I wanted to understand the gross margin decline versus last year. So our EBO mix, in fact, has improved, but our gross margins have actually by about 160 basis points. So what explains that?
See, this quarter, we've had some marketing offers debits from our large format store partners. And that is why, because it's come all in one quarter, that is, and we usually net off this against revenue because of Ind AS 115 accounting standard. And because of that impact of those marketing debits, our revenue has fallen to that extent, and this has led to the decline in the slight decline in our gross margin.
Comparable gross margins you're saying. So net, if you would like to call out the impact of this thing.
See, usually, on a steady state basis, Devanshu, we will maintain 60 to 60.5% or 60 to 60.5% gross margins consistently.
Sure.
But considering it's the same channel mix, if the channel mix tomorrow, as the EBO sales increases, the GM will increase. But taking the same channel mix, we will maintain 60 to 60.5% of gross margin.
Got it, sir. Got it. And sir, with cotton prices sort of being at reduced levels, sustaining at the current levels, how is the competition sort of taking it? Are they going for cutting prices, or so what's your plan on those fronts?
See, we don't have any plans to reduce prices, and even what we have studied from competition has also not reduced prices. Currently, these reduced cotton prices, we'll have to see the sustainability for 2-3 quarters. And then we'll have to see, because cotton prices in the last 18 months have fluctuated a lot. So for us to take a judgment on whether these prices will continue to be low, we don't know. We'll have to study this for 2-3 quarters. But having said that, we have not reduced prices, and we have also not seen anyone else in the industry reducing the prices.
Got it. And sir, you indicated that this was a challenging quarter, and I should sort of give you good compliments on maintaining a decent inventory levels. So what sort of helped us in maintaining the inventory levels despite shortfall in sales during the quarter?
No, see, I think, look, our inventory planning is very accurate, Devanshu. See, for us, all our inventory planning is through our ERP calculations and AI, what we have built internally. And everything is based on sales and sales projection. So we kind of very accurately planned our inventory thinking of how the quarter will go. Now, so we have done about 177 crores of revenue. Ideally, as management, we thought that we could have done about 184 to 185 crores of revenue. So we have fallen short by 6-7 crores to what we thought would have been a good number to achieve.
And this 6-7 crore, so there is a general trend that January is seeing relatively better performance versus what historical Januaries have been. So is that same trend visible at your stores as well?
Yeah, I mean, recent January has been pretty decent. So I mean, usually how January performs, we have seen similar trends in January this year. It's too early to comment because January is not concluded yet. But from what I understand, I see in the industry, it has been pretty decent, and it's been similar to past trends.
Got it. And one last question from my side. Generally, on an annual basis, we have seen about 10 to 15 store closures, and this year there has not been any store closure. So do you expect store closures to happen in Q4 or not?
Hard to say right now, but maybe 1 or 2 stores, nothing material.
Got it, sir.
There are one or two airport stores which we are considering to shut, but we have not finalized that yet, but maybe 1 or 2 stores maximum in the last quarter. Nothing material.
Got it, sir. Thanks a lot.
Thank you. Ladies and gentlemen, if you wish to ask a question, you may press star and 1 on your touchtone phone. We take the next question from the line of Mr. Varun Pratap Singh from ICICI Securities. Please go ahead, sir.
Yeah, thank you. So, sir, as you highlighted that depending on channel mix, the trajectory of gross margin would be taking shape. So just wanted to understand that in our current presentation, revenue contribution from online channels are close to 21%. Yeah, and if we look at your last quarter presentation, the revenue contribution is around 3%. So from 3 to 20%, it is quite a big jump.
No, Varun. There is a small correction there. I think you've read it wrong. The online is this quarter been 2.5%. That 21% you're saying is LFS.
Yeah, LFS. Okay. So I think there's some error in the presentation. Right. Understood.
No, okay. Maybe I'll have to check the presentation. Maybe the color coding was wrong. I'll have to check that. But the online sales, which was earlier at 3, is currently at about 2.5-3%. So it's been maintaining a similar trend.
Got it. Understood, sir. Okay. And so how do you look at the revenue contribution from this channel going forward, for example, next 2-3 years, especially from online channel?
See, we are looking over the next 2-3 years, we want to ideally scale the EBO business and online business together. Currently, we are at about 76%, both EBO and online together. We would ideally want it to be around 90% over the next 3 years, or a little more than that. We are aiming to get to that 90% number. And in that 90%, online would be about 8-9%. So currently, online is about 3%. We would like to take it to 8-9% of the overall thing.
Right. And that should not be a gross margin dilutive. I mean, our contribution from online.
That will further improve the gross margin. See, currently, based on the current channel mix, we have a steady state gross margin of about 60% or 60.5%. As the EBO and online sales contribution increases, because that is direct to consumer, that will have a positive upside on our gross margin.
I'm saying only for online channel, gross margin should ideally be dilutive, no sir, given the commission etc. that we have to pay?
No, what happens is the online, the commissions are booked below gross margin. So the gross margin in online and EBO are similar.
Understood. Okay. And sir, second question is on marketing spend. So given the renewed thrust on improving visibility and brand perception, so how should we look at the overall expense as a percentage of revenue?
See, on a steady state basis, Varun, you can estimate it to be between 3 and 4%. Usually, H1 will have higher spends than H2, because we usually plan our advertising spends prior to festive. So this year we had about 4.5% in H1, which has now come down to 3.5% for 9 months, because our spends in quarter 3 will less. So on an annualized basis, on a steady state basis, you will see about between 3 to 4% will be our ad.
Okay, understood, sir. Yeah, that's it from my side, sir. Thank you very much.
Thank you, Varun.
Thank you, sir. We take the next question from the line of Mr. Nihal Mahesh Jham from Nuvama. Please go ahead, sir.
Yes, thank you so much, and good evening to the management. So 3 questions. First, the clarification on the cluster approach that you mentioned. Just to understand that, right, you were basically highlighting that opening stores in the same cluster ends up impacting the SSG value and volume growth in a way. Is that the right understanding? Because the stores opening next to each other?
Correct. Sometimes it does, yes, correct.
That's helpful. The second question was that if I look at your city expansion over the last 5 years, you've consistently opened around 20 cities every year, and I think for this year also it is at 16. Maybe I think by 23 you will end up reaching a similar number. So is there a thought of accelerating that, or that is the template we want to follow in terms of the number of cities we keep expanding into?
See, it's very difficult to estimate how many cities we are going to add every year, because it's all based on availability of stores. But what I can tell you is that whatever 120 to 130 stores we are adding, 50% would be from the top 8 cities. See, our percentage of top 8 cities on a cluster-based model is about 56 to 57%. That ratio will maintain. Now, how many new cities we'll add every year is very hard to estimate. Sometimes 20 cities, sometimes 25 cities, all based on availability. But the mix of metros versus non-metros, which is currently at 57% by metros, the top 8, that will maintain.
Got that point. Just one last thing on the inventory side. Currently, we are at around 120 days of inventory, and that's a number that has stayed similar for the last couple of quarters. It has seen a YoY fall, but I'm guessing that is because of what had happened due to COVID last year. What is the roadmap from the 120 to 90 that you keep highlighting? What are the parts of the value chain where you will reduce inventory, and that will help you reach the number?
So, Nihal, let me clarify why 120 days and why we are at 120 days. See, as in our business, our sourcing model is as such where we buy fabric, we buy a raw material, and then we convert it into a garment. So there is an element of raw material inventory in our book. So if I take the 120 days, my garment inventory days is around 90 days. It's because of my fabric what I'm maintaining of 30 days, I'm having 120 days of inventory. So if I take in terms of real sense of finished goods inventory, I'm still at 3 months of inventory. It's just that the fabric is making it look at 4 months. Now, of course, our sourcing model has stayed consistent right from the beginning. So pre-COVID, we had 90 days of inventory, including fabric. So the little bit fine-tuning what we'll end up doing it to bring it down to 3 months is we are going to be fine-tuning the inventory at the warehouse. See, at the store level, currently we are having about 35 to 40 days of inventory on the overall sales. That will remain the same. The warehouse inventory and finished goods, we will fine-tune that a little bit, and we'll fine-tune the fabric inventory. So automatically this 120 days will come down to 90 days.
Including the fabric also?
Yes, absolutely. But it will take some time because the fine-tuning happens over a period of time. Maybe it will take 2-3 quarters or a little more, but we will bring that down to 90 days, which was the number prior to COVID.
That is helpful. Thank you so much. I wish you all the best.
Yeah, thank you.
Thank you, sir. We take the next question from the line of Mr. Manish Poddar from Motilal Oswal AMC. Please go ahead, sir.
Hey, hi, Varun. So, probably 3 set of questions. One is, would it be right that this quarter had the entire raw material impact? And let's say incrementally, raw material, let's say, sort of inflation will taper down?
Sorry, Manish, can you come back with your question again? I lost you.
So I'm just trying to understand, let's say, the gross margin which you see during this quarter, does this bake in the entire, all this inflationary impact which is there, let's say, in the inventory in the system? Is that how one should read in the gross margin?
See, Manish, the cotton prices which has reduced has actually not given the upside yet in the gross margin because our inventory works on a weighted average methodology. So right now the newer fabric what we are sourcing is on the lower cotton prices. So that has really not affected. The reduced prices have actually not got that positive upside on the gross margin yet. That will take some time for it to kick in.
So this should reflect by quarter 1. Is that how it is? What you're trying to say that
very hard to estimate.
But what I'm trying to understand is the exit prices which you got in, let's say, December, that would be at least, let's say, 2-10% lower than what the quarter average would be, right? Or that is still not the case?
No, see, the price increase what we have taken in December 2022, is more or less.
I'm talking about RM prices, not product prices. I'm just talking about, let's say, the cotton raw material which you get, be it either end product or a work in progress. Has that started reflecting lower prices because of the price correction which has happened in the commodities?
Yeah, I think that the price hike what had happened in December 22 at the RM front, that has already impacted the gross margin. So your question is right. So that increase what had happened at that point of time has already started showing in the gross margin, but it will not show much because we had taken a price hike also at the same time.
Right. Okay. And this second thing is, let's say these ad spend now we are calling out, let's say 3-4% for this year. So I believe at the beginning of the quarter 1, I think July, August, you mentioned about 4-5%. So is there a change in
No, I stand corrected in that. The 4-5% was more from a guidance of quarter 1 and quarter 2. For a year through, we are looking at 3-4%, not 4-5%. 4-5% is more from an H1 perspective.
Okay. Just one last one. So let's say this year this 130 odd store guidance, ballpark stays. Internally, are you planning to open higher number of stores in FY24 and 25?
We are yet to make that plan, Manish. So probably we'll have better clarity maybe in the next couple of months. But it will be in the line of more or less it will be in the line of 120 to 130 stores.
Okay, fair enough. Thanks.
Thank you, Manish.
Thank you, sir. We take the next question from the line of Nithili Balakrishnan from Alchemy Capital Management. Please go ahead.
Hi. Just a couple of questions. One is on this USS. Given that we have indicated that 96% of our sales were fully done, could you sort of just help us a little bit in terms of, was the USS during the quarter? Is it currently on? And what is the kind of response we are seeing?
See, so we have 2 USS periods effectively. We have one we run it during quarter 1 and one we run it during quarter 4. So currently we have an EOSS running. On certain articles we are providing certain offers. But the impact of such articles are very less because the total inventory which will be under these offers will be less than 15% or less than 10% of the total inventory. So the 96% of full price sales still continues to be.
Got it.
So because the offers are there at the store, but it is on very, very limited inventory.
And what
because in our business, most colors and products continue to the next season without getting discontinued. So we don't have too much of such inventory where we want to liquidate or discount.
Got it. And when did the EOSS start for us?
We just started now in January end. It will go on till February.
Okay. Also, just wanted to check on this ASP increase that we have seen on this 9-month basis. How much of it is mix and how much of it is pricing increases per se on a like-to-like?
This ASP what we have seen increase from 709 to 724 rupees was based on new products. Because the last price hike what we had taken was in December 2022. And
21
would be no 22 we took, no? Sorry, 21. I stand correct.
21.
December 21, yeah. So the last price hike we had taken was in December 21. And mostly after that we have not taken a price hike. So this slight increase in average selling price from 709 to 724 would be on the basis of new products, largely driven by new products.
Correct. Just wanted to also get a sense from you on the outlook which you had spoken about that, there was a certain part of the sales which, you expected the sales to be higher by 6 to 7 crores, which didn't finally occur. Was it a consumer sentiment thing or, could you just sort of elaborate a little bit on what you are seeing in the demand then and what are you seeing currently?
See, I think, look, overall the sentiment has been pretty decent. I mean, look, I wouldn't call this a bad quarter. The sales are pretty good. But see, look, we had a management expectation of about 184, 185 crores. We ended up with about 177. So the consumer sentiment has been pretty okay. We thought it could have been a little better. But otherwise, November was quite a sharp fall. October and December were pretty good.
Got it. Also wanted to check with you on 2 other points. One is on your EBITDA margins. While you have indicated your gross margins. Hello. While you have indicated your gross margins would be in that 60 to 60.5% range, would you have a similar range which you are thinking for the EBITDA margins?
See, on a year-to basis, we are looking to maintain EBITDA margins of about 32 to 33%. Post-Ind AS.
Post-Ind AS. Got it.
Yeah, on a year-to basis.
On a full year basis, some quarters will be higher, some quarters lower. Got it.
Correct.
And in terms of the loyalty program, is there any further action which happened along that side?
See, we have already made the loyalty program. We are just in the final rounds of testing. Hopefully, we should be taking it live starting first quarter.
Okay. And my last question is on the pledge. Just wanted to get a sense from you that you had mentioned earlier that it would take 6 months to sort of get it out. Does that still stand in terms of?
Our original plan was to close it by September 30th. It was, and it continues to be short-term in nature, the pledge. As family, as promoters, that is on our top of our priority list, and we're looking to close it soon as possible.
But there is no timeline that you are giving for it.
As of now, we're not giving a timeline, but we continue to maintain saying that it is short-term in nature, and it's on top of our priority list to close.
Got
but
it.
Hard to give timelines right now on that.
Okay. I just wanted to get also a sense from you of the rental to sales ratio that you are seeing currently for the 9 months of this year.
See, at a company level, we've had about 14 to 15% as rent to revenue ratio.
Okay.
But that's an overall sales basis. If I look at an EBO level, EBO channel, EBO level, it will be about 17-18%.
17-18%.
But at a company level, because at an overall company sales, it will be about 14 to 15%.
Got it. But coming to this, opening more stores, especially in a cluster basis, we are now seeing some amount of, this cannibalization happening on the volume side. That which earlier was not the case, and clearly the market is a little more saturated than we might have expected.
Right.
Just wanted to get your thoughts on this, especially given that you are indicating that you want to be at that 4 to 5% SSG level at the store. So, how are you sort of thinking about it, and like on incremental stores, are there any metrics that you'll keep a close track on that, if things don't work out appropriately, then you might look to even close some of these stores?
See, for us, closure of stores don't happen a lot because we are a fourth or fifth mover in any market before we open a store. We typically wait for the larger retailers to open first. We judge their performance, and then after that we decide to open a store. So closures in our case is very limited because we are the fourth or fifth mover in any market. But considering how we are growing in clusters, the right metrics to be used in our evaluating our sales is obviously SCSG, which is same cluster sales growth. But as management, we continue to aim that at an SSG level, we will want to maintain about 4 to 5% volume growth. We would want to at least aim and try maintaining that.
Got it.
But our experience has been that even in a cluster, though in a cluster, multiple stores sometimes cannibalizes the first or the second store of the same cluster, it does not really reflect in the decline in margins because the incremental increase in revenue to the incremental increase in the rent and other expenses is far greater in revenue than the expenses. So the margins, for what I have noticed at a cluster level, pretty much maintained. If not, gets better.
Got it. But you are closely tracking these margins at a cluster level, including rent.
Because we look at cluster as one location, right? So we take out EBITDA, we take out gross margins at a cluster level and then see whether there has been a decline after adding more stores. And that trend, we have not seen any decline.
Okay. Thanks a lot. That's all from me.
Thank you.
Thank you. We take the next question from the line of Mr. Vikas from Equarius. Please go ahead, sir.
Yes, thank you so much for the opportunity. Just a couple of quick questions. So can you break this 10% SSSG that we clocked into a pricing or a volume-led breakup? Can you please do that?
Yeah, so the 10% when it converted into volume, it is minus 2%.
Volume is minus 2%. All right. And sir, I missed the mark when you said that you ascribed a reason for the decline in the gross margin for this particular quarter. Can you please repeat that? What was the reason?
Yeah, see, this quarter we've had some marketing and offered debits from some of our large format store partners, and such debits are knocked off in the revenue. And because it is adjusted in the revenue line item, we have seen a slight decrease in the gross margin.
Sure. So this is more to do with than the nature of this item. It does usually happens every third quarter, or what is the time period?
It differs. It happens every alternate quarter, but this time the amount was a little more than normal. See, what these offers are basically, many of the large format stores run many schemes in their stores, like on a bill basket they'll give a particular offer. They run some marketing campaigns in their stores. So such initiatives are basically borne by the brands, external brands, and also borne by their private labels. So proportionately, we have borne our contribution.
Correct. But this is a normal business phenomenon that's easily incur every quarter, right?
It is always in the normal course of business. It's not an outlier.
Understood. Sir, and with respect to the stores opening, you did reaffirm that around whatever usually in a particular year.
I just want to confirm one more thing. This comes every quarter, but this time because of it being a little more than normal, that's why we have seen a decline in the GM.
Sure. I understood. I got that. Sir, last question. With respect to, you did mention that whatever store opening that would have on an annual basis, either 120 or 130 stores, around 57 or 58% would continue to be open in top 8 cities. Is that understanding right?
Yeah, about 50 to 55%. See, in our existing cities also, we are seeing a lot of scope of growth. So I think that 50% of our coming from our top 8 cities or top 10 cities will continue.
Understood. So, in that case, can I ask a broad question as to we do mention in our presentation that our revenue from a particular mature store will be around 85 to 90 lakh rupees, right? So out of this 600 odd stores that we have, around how much percentage of our stores would be clocking such revenue throughput?
See, the 85 to 90 lakhs is not for mature store, that's a blended number.
By blended number?
Meaning it is also including the stores which have opened in the current financial year. It's a blended number, the 85 to 90 lakhs. It's not for the mature stores only.
All right. So a mature store will be even clocking higher run rate.
Ideally, it should be clocking a little higher. I don't have that number handy, but it will be clocking higher.
Sure. So
how do we measure maturity? Any store which is greater than 18 months, we put that as a mature store. So we measure maturity by time and not by revenue.
Understood.
Yeah.
All right, sir. Thank you so much, sir. Thanks.
Right.
Thank you, sir. We take the next question from the line of Mr. Akhil Parekh from Centrum Broking. Please go ahead, sir.
Hi. Thanks for the opportunity. My first question is on the demand trend, right? You highlighted October and December was good. Would you be able to bifurcate how different or similar they are in, say, Tier 1 city versus, say, Tier 2, Tier 3, Tier 4?
See, I think the real difference happens at a state level and not at a tier level. I'll give you an example. Now, Delhi, for example, let us take the Delhi region, right? And suburbs of Delhi. October, November are usually good months. December starts to decline because of winter. Okay. Now, in South, the trend is very different. October does very well because of Diwali, and then December around Christmas, New Year, the sale again picks up. So the trend really differs between individual states and not at a tier level.
Okay. No, you answered from a seasonality perspective probably, but I'm just saying in general how the demand trend is there.
In general, what happens usually festivals fall in October, and even this year it was in October. So October usually sales spike. November again, after festival, the sales slightly takes a dip in November, and then in December, because of New Year and Christmas and the holiday season, December again the sales spike. So it usually November is slightly lower than October, and December picks up better, and December usually becomes on par with October. This is the usual trend. It depends when the individual festival falls.
No, but my question, where I was coming from was like we are seeing, right, the impact of inflation hurting the consumer segment more so people who are in Tier 2, Tier 3 towns, which is evident from the numbers reported by some of the FMCG companies. Are we seeing such kind of a discrepancy between the Tier 1 versus a Tier 2, Tier 3 store in terms of a demand?
See, in our case, we have not seen any such disparity as of now. For us, our Tier 2 is continuing to do as well as our Tier 1. So we have not really seen too much of disparity between Tier 1 Tier 2. But having said that, look, we are more currently looking at our network. If you see 60% of our stores are in top 8 cities. So currently we are more Tier 1 from a network perspective. But whatever we have in Tier 2, Tier 3, Tier 4, we have not seen any as such fall. I mean, no greater fall than what has happened in Tier 1. Let me put it that way.
Okay. So SSG volume of -2% would be broadly similar across the tiers.
Yeah, it would be similar.
Okay. Second question is on the ASP front. You said that you've seen a kind of plus 10-11% of ASP increase probably on a YY basis. Are we seeing any trend where premium products are getting sold way more than what they used to be, and probably mass products or the entry level products are getting sold less currently as compared to say in last 1-2 years?
We have not seen any dramatic shift on that front. I think it's been fairly similar and consistent to what it was before. So we've not seen really any big change on the premiumization front. Look, the customer is upgrading, and that's why our ASP is increasing. But there's no dramatic shift.
Okay. Okay, fair enough. And last question on the...
But to your question, there is a shift. That's why you have seen our ASPs increase because of the new product portfolio. There is a shift, but it's a very slow and gradual shift.
Okay. Oh, fair enough. And lastly, on the ramping up of newer stores, right? I mean, I'm sure the newer stores would be clocking say only 30-40% of the sales as compared to the very mature store sales. So how does the timeline looks like? So say, for example, if I open a new store today, how many months or years it takes for that store to reach to the sales level of our very mature store?
See, like I was mentioning on the call, maturity for us, we measure not by revenue, but we measure it by time. See, we have some older stores also, which is well below the average of 85 lakhs. And we have some newer stores also, which are well above the 85-90 lakhs number. So for us, for a store to be matured is by time and not by revenue. So usually between 18 to 24 months is when a store gets matured.
Okay. Okay. That's all from my side, and best wishes for coming forward.
Thank you.
Thank you, sir. Ladies and gentlemen, in order to ensure that the management is able to address questions from all the participants in the conference, please limit your question to 2 per participant. We take the next question from the line of Mr. Himanshu Nayyar from Systematics. Please go ahead, sir.
Hi. Good evening, Gautam and Mr. Mohan. So first question, I mean, given that you said the demand trends are very similar for you in both the metros and the larger and the smaller markets. So just wanted to understand, is there any notable or significant difference in the store economics for your stores that you open in the top 8 cities versus your other stores? I mean, given if you open a significant proportion in your non-top 8 cities, would that impact our overall store economics or not much?
See, from a margins perspective, margins are very similar between tier 1 and tier 3, and I'll tell you why. So there will be a difference in revenue. So the top 8 cities average store revenue versus a tier 3 cities revenue would be different. In tier 3, the revenue levels per store would be lower. In our case, it is not significantly lower, but it is lower. But what happens is, even when these revenues are lower in tier 3, our other costs like rental, staff costs and other expenses also are that much lower. So the kind of EBITDA what we generate at a average store level EBITDA of 31 to 32%, whether it is a tier 3 or whether it is a tier 1, we end up delivering the same 31 to 32% EBITDA. So there's no change in the margins as such, but the revenues would be different for a tier 1 versus a tier 3.
Okay. And return ratios, inventory, that would again broadly be similar, is it?
No. There will be a change. So the return ratios in a tier 3 would be slightly longer because the investment for you to put up a store as far as capex and inventory, whether it is a tier 3 or the tier 1 is the same. So your payback period is likely going to be longer in a tier 2 versus a tier 1.
Got it. And second bit was on omni-channel journey. So can you share some details as to where we are in that journey, and if we have already started it in a significant number of stores, any initial data on how much is that adding to our store throughput or revenue per store basically?
See, we have started omni-channel in a small way and we started seeing some success. It is still early days. So we have started doing localized deliveries from certain stores and it is scaling up. We've also now making a omni-channel program where any customer who walks into a GoColor store and if she's not able to find a color and size, we convert that customer into an omni-channel customer. So we are initiated and right now we have done it in a few stores. So it's very early on to say how the result is, but it has gone live in a selected number of stores.
So any idea, I mean, how much you think that can have a significant impact on our store throughput?
Exactly. So that was the idea. I mean, we are quite optimistic that it should improve the store economics and the store throughput. But since we have piloted in a few stores, even the staff are getting trained how to use that omni-channel module. So it will take some time. for us to really know how much is the output increasing. So we have done a small pilot in 4 to 5 stores.
Oh, so it will take it's still a long time away that we actually start seeing a material.
Because there are so many integrations we need to do at a software level. So we have piloted in 4 to 5 stores to see how it goes.
Got it. All right, that's all from me. Thanks, guys, and all the best.
No problem. Thank you.
Thank you, sir. We take the next question from the line of Saptarishi Chatterjee from Centrum PMS. Please go ahead, sir.
Yeah, good evening and thank you for the opportunity. So my question is, sometime back you have talked about your repeat customers around close to 30-35% of the total customers. If you can talk about how that has moved and if your product per customer has also grown QOQ or YY.
Our repeat purchase was about at 40 to 45%, and that has more or less maintained. From the other point data, what you mentioned, whether the same customer is buying a lot more or not, that data we have still not tracked in this quarter. Probably when we have little more information on that, we will circulate it. But our repeat purchase at 40 to 45% has maintained.
Understood, sir. But also, like, do you track whether a same customer with vintage, someone who is buying 2 years, 3 years back with us, is buying more? Is there any evidence or data for that?
No, that's something. We have not tracked that data in the last couple of quarters. But what data we track, I'll tell you, which we have done very well in Q3. So we track how many customers have lapsed. So some data around the lapsed customer, we send out SMS and we have been able to recall many customers back to the store and converted those lapsed customers into active customers. So we have done that as well. So the customers which are very old and not repeat come back to the store.
Understood, sir. Helpful. And secondly, would want to know what are the parameters you track for the brand recall as a like Go Colors on all omni channels and how do you track that?
See, offline there is no real one way to measure it, but in social media and digital world, there are some third-party agencies through social media and digital. They are able to tell what is the recall value. There is some metric and math they use, but there are some third-party agencies doing that. In the social media space and digital space, in the offline space, there's not really any real way to measure the recall, unless we conduct a customer survey.
Okay. But do you can you quantify like what has been our brand recall as for the third party agencies?
Yeah, so in fact we had a recall. We did a small brand campaign also. So in the social media space and business space, we had a brand recall. Post our campaign, we did a study. It was about 23%.
Versus like YOY or something. How to compare that?
This campaign we have not done before. This was the first time we have done this.
Understood. And last question from my side is that like you have talked about maybe around 120 kind of store additions every year, and we have a visibility of maybe another 500 stores. But in terms of like we are seeing some bit of volume cannibalization within the stores of same regions. How our number of locations are going to grow in next 3-4 years?
See, we are going to continue to grow in clusters, and that's why for us, same cluster sales growth is a much better metric than same-store sales growth. So we are going to be continuing to grow in clusters because ours is a cluster-based expansion model. So over the next 2-3 years, we will continue to add 120 to 130 stores and a good number. It's very hard to say how many will be coming from the existing cluster, but it's going to be that driven model only.
Okay, then. Thank you so much and all the best.
Thank you.
Thank you. A reminder to all the participants, in order to ensure that the management is able to address all the questions in the conference, please limit your question to one per participant. We'll take the next question from the line of Prerna Jhunjhunwala from Elara Capital. Please go ahead.
Thank you, sir. One question from my end is, how much of your sales would be new product sales versus core product? This is to understand the impact of raw material movement as well, because you've not taken a price hike since December 21, and there has been a material improvement, increase in the cost of raw material as well. So just wanted to understand these two factors.
See, for us, whether new product or old product, our gross margin structure and multiplier is the same. So even if our newer products are selling or older product portfolios are selling, our gross margin profile, which is we are having at a EBO level, we have about 68 to 69%. That maintain, and that will translate to 60 to 68% at a company level. So the margin profile is very similar in all our products. So we don't have that differentiating between a new and an old product.
No, it is from the point of raw material actually, because if raw material prices have increased by 30, 35, 40% without price hike beyond December 21,
so I'll tell you. In fact, our raw material price, the raw material prices have increased twice, and around the same time we had also increased the price of the product. So I'll tell you, the first increase had happened in April 21 or March 21. Whether there was a sharp increase in RM prices, and we had also immediately simultaneously increased our product prices. The same trend happened in December 21, which I had also mentioned earlier in the call. The RM prices went up in December 21, and we took the product price hike also in December 21. So when we are taking the hike with the increase of the RM hike, it kind of counterbalances.
Okay.
So it's very hard to say that when is the impact coming, because the newer inventory, when we are changing our prices, the newer inventory coming in is going with the new selling price. The older inventory in the channel is still selling at the old price.
Okay, understood.
So the increase in the RM and the increase in the selling price go hand in hand, is what I'm trying to tell you. And the last increase of RM and the last increase of selling price happened in December 21.
Okay, and now if cotton prices come down, then what do you do to your ASP? Because just trying to understand on the core product, do you reduce your ASP?
No. For us, it's not possible for us to reduce the prices. So even if tomorrow the RM prices fall, and it's already fallen, if it consistently maintains, even in that scenario, we will not be reducing our prices.
So your gross margin should increase then.
If these reduced cotton prices continue, then our gross margin should increase.
Okay, understood. And could you share the number between the core and premium product revenue share? It will help.
Currently, it's the same ratio of 50-50.
Okay, and historically, maybe 3 years back?
3-4 years back, it was more 60-40. Now it's become 50.
Oh, thank you so much.
Thank you.
Thank you, ma'am. We take the next question from the line of Mr. Aditya Sharma from Aditya Birla AMC. Please go ahead.
Hi, sir. Thanks for the opportunity. Just wanted to understand this. We have completely outsourced in terms of manufacturing. So can't we use the procurement can be done by the outsourcing companies to whom we are outsourced, and actually save around 60 days in working capital? So as you talked about, 30 days are in terms of inventories occupied by the RM that you're procuring. So that could actually in turn become payables, and the company could actually have a much better cash flow from operations and much better working capital. So I just wanted to understand, are we prioritizing cash margins over cash flows, and can we actually implement this model?
See, I'll tell you, because of this model, what we work on, margins definitely are better because we source fabric directly. But having said that, see, the reason why we are sourcing our fabric directly and raw materials directly is because of the quality. See, we as a brand, the fabric quality, it plays a very, very important role in a garment. And that is why our customer keeps coming back to us. So that quality, we want to have it in control. And that is one of the reasons why we buy our fabric directly. And now coming to our subcontractors, you see, we work with very small subcontractors. We work with multiple subcontractors, but we work with very small subcontractors. Those subcontractors don't have that kind of financial strength to buy the fabric directly. Also.
Okay.
And because we are working with such small subcontractors, we are able to source a better rate on the subcontracting charges. Whereas if you go to a larger export firm or a garment manufacturing firm, their cost of doing the conversion in CMT versus the smaller subcontractor would be far higher. So we work with the smaller subcontractors, which gives us a upside in our CM charges. Upside in the gross margin. Upside in our sourcing.
Got it. So I get your
But the primary reason of doing this model is because we want to control the quality. More than margin, it's more from the reason of controlling the quality on the product.
But we also can actually have our from where we are outsourcing, we can ask them to actually
nominate the supplier.
Buy from our supplier list, which
we are doing that. We are doing that, Aditya, but but there are many subcontractors who won't be able to do it. Now, if I take our entire sourcing model, there are many places.
Yeah. Correct. So what has changed in our inventory? So we are having the same model, but before we had 90 days. Now it's consistently around 120 odd days. While we were understanding that the RM prices have shot up and there was uneven demand, and probably that could actually result in such kind of high inventory days. So I just wanted to understand this inventory piece, like what has resulted in this higher inventory days from the previous years?
I think, look, during those periods of COVID, I think inventory planning became a little difficult at that point of time. And it was during the period of COVID where our inventory days went from 90 days and it had gone as high as 170, 180 days. So we've been able to bring it to 120. I think COVID was that scenario and that situation. But now since we have somewhat brought it down to reasonableness of 120 days, we're further wanting to optimize it to 90. But it was a COVID window when this happened.
So can we achieve this in a couple of quarters, or what's the timeline for 90 days?
We ideally are looking at 2-3 quarters, a little more to stabilize this at 90.
Got it. Thank you so much.
Thank you, sir. We take the next question from the line of Mr. Rajiv Bharti from DAM Capital. Please go ahead, sir.
Thanks for the opportunity, sir. So can you call out the rent and the FCF number for the quarter?
Just one second, I'll check. Just one second, I don't have it handy. I'll tell you just a second.
What is the figure he's asking?
The rent, I'll tell him. The rent is, we have paid 23.5 crores of rent in quarter 3 FY23.
Okay. So this is entirely the fixed rent, is it? Below EBITDA?
No, this is rent, correct.
Okay. And let's say the OCF number or the FCF number for the quarter, because the 60 crore is for 9 months, right?
Yeah, so the 60 crores is for the 9 months. So for the 9 months, the 60 crores is on the basis of Ind AS 116. If I look at pre-Ind AS operating cash flow, it is nil, because we've had 60 crores of rent and we've had 60 crores of cash, so it's basically nil.
Got it. But for the quarter, I just want to get a sense.
No, we paid the cash flow for 9 months.
Okay. And one question on, let's say, on loyalty. I think it was asked before. Do you have a metric which you are, let's say, accumulating right now in terms of tracking the loyalty, the repeat part of the purchase?
See, loyalty for us right now is not gone live. We are testing it. We are making the program. Hopefully, loyalty should go live from Q1. That is what we are planning. But as far as repeat customer base is concerned, our repeat customer rate is at about 40 to 45%, which has been consistent over last 1.5 years what we have seen.
Right. Okay. That's all from my side. Thanks a lot and all the best.
Thank you.
Thank you, sir. We take the next question from the line of Mr. Gautam Rathi from CWC. Please go ahead, sir.
Hi, Gautam. Thanks for taking my question. The first one actually we wanted to understand, so you said you took a price hike in December 2021, right? So generally, when you see your history of last 5-7 years, whenever you take a price hike, how much impact does it have on your volumes, and how much time does it take for the volumes to come back to a normal level, right? Is there a correlation there?
See, usually we have not seen a volume impact because of price hike. Because when we do a price hike, very rightly you said we took it in December 21. Whenever we have taken a price hike, we have taken it with the entire industry. So it's usually that for a customer that experience of price hike is across all brands. We have not seen a volume impact because of price hike in our old experience. See, because we increase our prices only if there are long-term fluctuations in raw material pricing. See, short-term, if there are any fluctuations, we absorb it because we have the gross margin to absorb. But any long-term fluctuation, that is when we increase, and when in such fluctuations, the entire industry takes along with it.
So Gautam, Nishit here. Next quarter, the price hike that you had taken in December 21 will come into the base, right? Then the impact that you were getting because of higher prices will also come in the base. And the question which you are trying to understand is, your volume growth being where it is it possible that the growth will start to taper off a bit?
No, so you're saying, can you come again with the question? I didn't clearly understand.
Basically, there are three elements which are there in your growth. One is the volume growth that you're getting. Especially in your SSG, that most of the SSG is coming from prices, right? You have around a 10% SSG, wherein volume growth is -2, right? And if the volume growth has not been impacted by the prices that you've taken, the next quarter onwards, the prices will be in the base of the previous quarter last year, right? So in that sense, the quarter will be the growth will start to normalize, right? Unless you take another price hike now.
See, I'll explain the question. No. I'll explain the question. I understood where you're coming from. See, we as a company, we don't want to increase our prices every year to drive growth. We will increase the prices only if there are changes in raw material prices. Now, as far as how are we going to be growing, growth is going to be at an SSG level, we want to grow at 4 to 5%. But having said that, our ASPs will keep increasing because of the new products coming in. So we are looking at a value SSG of about 10%, in which 4 to 5% will be driven by volume, and the balance 4 to 5% will be driven by ASP, which is going to be driven by new product portfolio and not change in pricing of the existing products.
Okay. But your historical SSG was much higher, which now you're saying you believe that the SSG should grow at 10%. And the second thing is in this quarter you were at -2. So will it will take some time. The question I'm trying to understand is the -2 to 4 to 5 will take some time, right?
No. See, that's what I'm saying. So the -2 happened because obviously this quarter was a little tough. But in our business, the right way to look at it also is through the SCSG mechanism. In the SCSG data, we've had 11% volume growth in this quarter on a YOY basis.
Which is fair, which I understand, which is a fair. Okay, that's perfect. The second thing which we wanted to just understand is the seasonality bit, right? And I'm just talking from I think one of our previous conversations you had mentioned that the way you think about seasonality is broadly 45-55%, right? 45% in H1, 55% in H2. Does that remain, or is this year an exception to that?
I mean, see, these were the patterns prior to COVID, but this is the first full year after COVID. This is the first full year, so we'll have to see. But looking at the current year trends, it is looking at the same trends of 45 and 55.
Okay. If it is 45, which will mean that Q4 could see further acceleration. That is the only limited point, right?
No, usually quarter four is the weakest quarter of the year.
Exactly. Because it's Q4.
Yeah, but usually 45 applies for us because we are adding new stores. So the stores which have opened the first 6 months of the year, they normalize to a certain extent to give revenue in H2. And that is why the 45 rule applies to us. But on a same store basis, the quarter four is the weakest.
Understood. And just one last clarification. So when you say you usually consider 18 months for a store maturity, right? So, and when you call out these SSG numbers, are these also for those 18 months base, or is it a different time period?
It's a blended number. It's a blended number right from our oldest store to our newest store. Then see, okay, what qualifies under SSG? Any store. So let me clarify. So now we had 10% SSG, right? Q3 FY23 versus Q3 FY22. Now what are the stores what are going to be considered in SSG? All stores which have opened before October 1st, 2021 are going to be coming under SSG evaluation. The store has to be live for a full quarter in comparison for it to be evaluated in SSG.
Correct. So October 2022, right? Before October 2022.
No. All stores before October 2021 because we are comparing it on a YOY.
Correct. So full year.
Understood. Okay. Thanks a lot.
Yeah. Thanks.
Thank you, sir. Ladies and gentlemen, that was the last question for the day. I would now like to hand the conference over to the management for closing comments.
Thank you everyone for joining us. I hope we've been able to answer all your queries. We look forward to such interactions in the future. We hope to live up to the expectations of you in the future. In case if you require any further details, you may contact Mr. Digen Gruber from SGA, our investor relations partner.
Thank you. On behalf of Go Fashion India Limited, that concludes this conference call. Thank you for joining us, and you may now disconnect your lines.